Welcome back. Earlier today, the personal consumption expenditure, also known as the PCE, was released, showing inflation is back on the rise. The PCE rose 3.3% year over year versus the prior report of 3.0%. Core PCE, excluding food and energy, also up 4.2 versus a prior 4.1. This is also skewed the federal funds futures along with the Fed speaker in just a moment. Here's a PCE month over month in blue, the core PCE again in red, excluding food and energy. We can see relatively speaking, it's lower than it has been in several months. However, this is on a month-over-month basis, so this really doesn't take into consideration seasonal factors. The year-over-year figure, I believe, is a lot more accurate and telling of the state of the economy. Here's PCE year-over-year in blue, core PCE year-over-year in red. Again, red excludes food and energy. Food and energy are considered to be more volatile components of the index. So inflation, when it rears its ugly head, we see the blue line tends to go up more than the red line. And conversely, when we have a very deflationary period, we tend to see the blue line go down more. The Fed's target, again, by the way, is 2%. The Fed has said even very recently as this past weekend, and actually even more recently than that the Fed is staying pat on its 2% target, which means until and only when the PCE and core PCE return down to the 2% level, the Federal Reserve will continue to raise interest rates. And we can see today's report actually marks a tick in the wrong direction, back to the upside. Here we see PCE year over year in blue, federal funds in red. This is the interest rates, Federal Reserve interest rates. And we can see that during a period of very low interest rates, that was the cause of all the inflation we see now, in addition to a lot of spending, of course, as well. The Federal Reserve started a very aggressive interest rate tightening cycle. Some would argue they probably started too late. Reason being is that we have a 2% target. This is the 2 on the right-hand side. That's the 2% Federal Reserve target. When the PCE crossed above 2% in January of 2021, should they have begun to raise rates around that time? Maybe so. Why did they wait so long? Why did they wait nearly more than a year, about 14 months, to start raising rates after the PCE reached above the 2% targets? Now we can see over here, this is PCE year over year in blue. The red is the S&P 500. And not surprisingly, there's a pretty strong correlation, at least until recently, which again is a phenomenon we talk about over and over again, that when the blue line went up, that's the inflation rate, and the red line, that's the stock market. They've gone up together, which makes sense. When inflation goes up, typically it's a sign of a strengthening economy. We have more to spend, prices for homes go up, investments go up, that sort of thing. But Federal Reserve started to raise rates and they tried really hard to cool the economy. Well, they did start to really cool the PCE number, the stock market back to the upside. The question is the stock market rally based on true corporate earnings? Is there something else? Maybe there's expectation that if there's any sort of downturn, that the Federal Reserve will very quickly, cut interest rates. All that's guesswork. But maybe that's the reason why the stock market seems to be so resilient. Nevertheless, the stock market really is very stubbornly going higher despite falling inflation. Now, it's a double-edged sword because then you could say, well, inflation is not good for stocks. After all, it makes it more expensive to, buy homes and invest in companies, that sort of thing. But what we're looking at are long-term economic trends, and generally speaking, stocks go up during an inflationary period because usually an inflationary period is the sign of growth. Yesterday's GDP number that we talked about maybe would disagree. Now, there are different measures with inflation. We have the CPI and the PCE. PCE is what we're talking about today. The Consumer Price Index is also a measure of a basket of goods and services that represents the average consumer. There are differences, nuances to these two different numbers. The PCE is a more comprehensive measure of spending than the CPI. It allows for substitution of certain items. Also, PCE includes medical care, Medicare payments paid for by the employer provide insurance. That is included in the PCE. There's more government programs. So when the value and the expenditure of government programs goes up, that is more accurately reflected in the PCE. Well, you may wonder, what's the difference between the PCE and CPI in terms of a chart? Well, this is what it is. The blue line is a CPI, the white line is a PCE. Think of the blue line very simply as a more, I would say, a more accurate measure of the typical consumer, not including government programs, not including, some of those extras, just what we typically buy, shoes, cell phones, automobiles, washing machines, not necessarily employer provided for healthcare and government programs, things of that nature. Well, earlier this year and late last year, we did see quite the divergence with the CPI. That means the inflation affecting what we would consider to be the average consumer went up more than the PCE, including the government programs. But that has really returned. And it seems that inflation, that these government programs and Medicare, it is playing less of a role in the inflation that we see. In other words, the inflation that we see is affecting everybody, I would say, more equally. Now, the gray histogram bars in the background very simply show a comparison between the CPI and PCE. It's actually just the CPI divided by the PCE. So when this gray line, these gray histogram bars go up, it means the prices for those consumers go up more than the inflation measured, including, Medicare, things of that nature. But it's flat now. And again, it really does show us that the inflation that we experience is being experienced by everyone, and it's not necessarily being masked by so many programs. Here we see PCE in blue and core PCE in red. Now, this is 1970 through 1988. Now, of course, we know in the mid and late 70s, we had periods of very, very high inflation. And just curious, we wanted to show you because it shows the same kind of pattern. Notice the blue line. The PCE is much higher than the red line, the core PCE. Food and fuel are the more volatile components of this index, and that therefore, when they go up, food and fuel, which is included in the blue line, goes up more than the red line. Conversely, when we see a downturn, we had that stock market crash, by the way, late 87, we see food and fuel goes down even more. So if you want to maybe use food and fuel as the canary in the coal mine, a secondary leading indicator, so to speak, when we see gas prices go up, that may eventually translate into other items. And analysts on TV, they'll always talk about the fact that hey, when gas prices go up, it costs more for the trucking companies to bring all the items that we buy online to our homes, that sort of thing. And it really is true. And I think this chart actually kind of shows that when you see the price of gas and food go up, maybe it means that other items are going to go up as well. Now, left-hand side here is PCE year over year. This is 2006 through 11. PCE year over year on the right is present day. Now, we take the period of time 2006 through 11 because it shows a very strong economy that turned into a very weak economy. And we can see at the peak, PCE was at 4%. Well, the peak this time around was around 7%. The 4% eventually led, and that was early 2008. Inflation was actually very stubborn all the way to the end. The stock market really didn't start to crumble till about the third quarter of 2008. And then when it eventually did go down, we saw a negative, negative 1.5 inflation rate at that point. Notice from the top to the bottom, we hit the top, let's say about mid 2008. We hit the bottom around early mid 2009, about a year. Well, we hit the top of inflation about April or so of last year. We're definitely a lot further away from that. And we can see also, very simply, take a look at the angle of decline. We're going down in terms of inflation, but maybe not as quickly as we did in the past. This seems to be a very fast, precipitous fall of inflation in 2008. It seems to be a lot more stubborn. We didn't see any upticks along the way here, too. It's literally a straight line down. Here we see one, two, three. This is the fourth uptick in about a year or so, where inflation just seems to be very, very sticky. Here's core PCE, same time frames, left-hand side 2006 through 11, right-hand side is present day. Now this excludes food and energy. Take away the more volatile components, and this is a more detailed a chart with a lot more nuance, I would say. We hit the top 2006, around December, around 2.5, 2.7% inflation. We wavered for about 2 years, and then eventually that big, huge precipitous drop ensued afterwards. But notice inflation was actually weak for quite a while. This, I think, really does reflect the fact that if you recall in 2007, oil prices were very, very high. And if you include oil prices, here's a prior chart, left-hand side. This includes oil prices. Take a look at how sticky, how resilient inflation was. It was going up. Now, take away oil prices, different chart. Again, with oil prices from 2006 to 2008, inflation was going up, including, sorry, excluding oil prices, they were actually falling. So I would say the core PCE is a lot more indicative of the economy. Those high oil prices really kind of masked where we were. Well, let's go back to 2006 through 11. We can see a very, very strong PCE on the right-hand side. Core PCE, also very strong, but it is a lot more sticky. Again, this is where we are, including present day, right hand side, including food and fuel. It's now going down a lot. Excluding food and fuel, interesting, it's not going down a lot. So, what this is telling us is now that food and fuel is actually the weaker component, opposite of what we saw. So, that really shows us, you know, there's a lot that we could say about this, but it appears, at least based on these charts, the inflation is much worse. Not only because it's higher in terms of the numbers, but also because the inflation is not just high oil prices. It's not just high food prices, which is bad enough in and of itself. But it seems that the inflation currently is a lot more widespread than it was in the prior go round. Now, Fed Watch, August 31st, 2023. It's today. President Federal Reserve Bank of Atlanta Bostic. He is in the South African Reserve Bank Biennial Conference. He was speaking. He said, in part, the Fed's monetary policy is appropriately restrictive. He says the Federal Open Market Committee should be cautious in payment and let restrictive policy continue to influence the economy, lest the committee risk tightening too much and inflicting unnecessary economic pain. Well, it sounds like he might have a little bit of a softer view. Maybe not. However, he does not favor easing policy anytime soon. So he actually agrees with Chairman Powell and the others. He says Atlanta Fed sticky price CPI, that's a CPI gauge we watch, the main barometer, was basically flat in June and July and rose just 0.8% annualized over the past 3 months after excluding food, energy, and shelter prices. He's talking about core CPI. The battle is not over, and it is essential that inflation be brought all the way back to the committee's 2% target. They are committed to 2%. The labor market could be cooling faster than headline monthly job growth numbers suggest, which I also agree with. So it's a little bit, I don't know, contradictory. But he's basically saying that, hey, the labor market might be cooling more than we thought. Now, we spoke about the non farm payroll recently. We spoke about, and we're going to talk about it again very soon as well, new month. But the last labor market number was not so great. Yesterday's GDP was not so great. but the Fed is staying pat on its inflation target at 2%. We know today its PCE is 3.3, so we still have a lot of work to do. Here's the question I would pose. Let us know what you think. It seems that the Fed seems to have a little bit of, this is my opinion, a skewed priority. Yesterday, we had a soft GDP number. It was expected at 2.4%. The actual number is 2.0. Shows us they're just slowing in growth. The last non-farm payroll and employment numbers were also soft. We also spoke earlier this month about manufacturing numbers. Empire State manufacturing number in New York. I know I was the Philly Fed was strong, but the New York was actually weak. Before that, seems like a long time ago, wholesale prices, wholesale inventories, I should say, are very high. And that means that there's really not a lot of demand out there. So it seems that there's a good amount of negative news and some news, I would not say positive, but news that is indicating or pushing the Fed towards raising interest rates, mainly today's number. Today's number tells the Fed raise interest rates. The most recent inflation numbers tell the Fed raise interest rates, continue to raise interest rates. 2% target. We're not wavering from that. But we know, we spoke about this, a few days ago about the Fed's dual mandates. They also have to make sure they don't really hurt the labor markets and they don't really hurt, the retail sales and the other parts of the economy. The economy is not just inflation. What do you think? Is the Fed not taking GDP and non-farm payroll as seriously as they should? Are they too are they being too strict on this 2% targets? Well, this is what the Fed Fund futures say today. The red line is the red dots represent the 525 to 550 range. That's where interest rates are right now. Federal Reserve has an 88.5% chance of not raising interest rates to keep them where they are right now, 5.25 to 5.5 range. They have an 11.5% chance of raising interest rates raising it from our current level to 5.5, 575. Now, yesterday we had that soft GDP number, and the market said, no, 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 GDP is soft. It was expected at 2.4%. The actual is only 2.0. We have a 90% chance in September the Fed's not going to raise rates. PCE today is like, no, no, no. Inflation hasn't gone away. The Fed should raise rates. And that's why we ticked down from 90 to 88.5. Also, Atlanta's Fed chairman, maybe his speech maybe also influenced the market to some extent. But the fact of the matter is, it looks like the Fed funds futures are predicting no interest rate hike in September. What are the odds are after that? Well, we still have a 2% target. So, certainly we would expect higher rates to follow. Let us know what you think. Is the Fed being too strict on their 2% rule given the very recent weak GDP and prior to that, other numbers? Or based on today's inflation number, do you think they're right in being so strict in their interpretation? We have a big economic calendar, with some news tomorrow, and then, of course, next week. We have a lot to talk about as well. And we'll be sure to update you along the way with any significant changes. We hope this has been helpful. We look forward to seeing you back soon.